So guys, thank you very much. And this is, I am between you and the end of today. So thank you for your patience. Today I'm going to talk about currency returns, currency risk, and monetary policy inflation. And this is going to fit very well with the previous presentation. But before presentation, this is joint work with Kemal, who is working at the IMF, so the usual disclaimers apply. This has nothing to do with the official position of IMF. The idea behind our paper is that we argue that what determines riskiness of a currency is how this economy responds to global shocks. So what do I mean by that? The traditional view that we teach our undergrads is that exchange rate insulates the economy against global shocks, right? But how does this insulation happen in this traditional Mandel-Fleming channel is that whenever there's a global shock to the economy, exchange rate depreciates, right? And when exchange rate depreciates, you start exporting more, and it stimulates the economy. So that's the traditional view. But we see that in a lot of countries, especially developing economies, emerging markets, this insulation doesn't work really well. And exchange rates are more volatile, and they tend to lose value in recession, so they are risky. And what we argue is that investors, seeing this, they demand higher returns from these currencies. And what does this has to do with the monetary policy? Well, this is about the returns, this is about the interest rates, right? But also there is the monetary policy aspect of interest rates. And if monetary policy does not respond to this risk premium, what happens is that policy rates can be too low, right? Because investors expect a certain return. And if the policy interest rate is low, you know, it's like a monetary expansion. And what happens in the steady state is that you can get a high structural inflation. And this high structural inflation is about risk premium in a sense. Let's take a step back. So let's think about currency risk, and there are two major views about currency risk. One view is that local factors determine currency risk and return. And this paper argues that this is especially the institutions, monetary policy determines how these currencies behave, especially in emerging markets. But we also know that global factors are really important, especially that when in the literature, people find that there are two principal components of currency returns, and they sort of explain 60% of returns. So 60% of exchange rate movements are driven by global factors. What we do in this paper is that we sort of bridge these two views. We argue that yes, exchange rate movements are driven by global shocks, but it's the local response of the economy that determines the riskiness. And so we are connecting the currency risk, which is a very high frequency phenomenon, to the structure of the economy, which is more long term. So let's talk about the data. Our data is from many countries, many emerging economies and advanced economies. So we construct monthly currency returns like this. So we have the local currency interest rates, we have the dollar interest rates, and we have the exchange rate. So the idea is that an investor can invest in dollar assets, fine. At the same time, this investor can take $1, convert $1 into local currency, invest it in local interest rates, and at the end of the month, convert it back to dollars. So this is our currency returns. And then, what do we mean by currency risk? So we basically follow the literature, and then we find two principal components of currency returns. And the first one is they call dollar risk. So all these currencies, they move against the dollar jointly, in a sense. But at the same time, there is this carry trade risk that determines safe versus risky currencies. So when this carry trade risk goes up, safe currencies appreciate and the risky currencies depreciate in a sense, okay? And so for example, I mean, when you take a couple random currencies, so in some emerging markets, around 60% of the currency movements can be explained by these two principal components. Basically, what we do here is that we regress currency returns on these risk factors. So, global risk is important. So these currencies are driven by, in a sense, global risk. But the question is, what determines their response? Okay, fine. Sorry. Here. Yeah. And then what we do here is that we regress average excess currency return of each currencies on their loadings or exposure to the risk factors. So what we find is that both factors are important, and jointly they explain around 50 to 60% of the excess currency returns on average. So in a sense, if a currency depreciates a lot when dollar risk goes up, that is a risky currency, and investors demand premium. Similarly, the same thing holds for carry trade risk. If a currency loses value a lot when carry trade risk goes up, investors demand higher returns on average. And so the question is whether this is a data fluke or whether investors are aware of this or whether investors have biased expectations. We also use exchange rate expectation data. So instead of realized exchange rate, we use 1 month expectation. And this expectation is by professional investors. And then we basically find this same thing. Whenever carry trade risk goes up, exposure risk goes up, forecast expected average return goes up. So investors know about this. In a sense, they expect higher returns, not only realize, but they expect beforehand from higher returns from currencies that have higher risk. For the dollar risk, I mean, this is not super significant, but if you remove these two currencies, it could be significant anyway. And South Africa is here, like here, sort of in the middle. So what we do here is that we sort of know this exposure to these currency factors, but we don't know what these factors are, in fact, and what determines a country's exposure to these risk factors. So what we do here is that we collect variables in the literature: net foreign asset, foreign liabilities of banking system, dollar invoicing, reserve size and centrality, to see whether any of these currency risk factors that are explored in the literature are correlated with the exposure of our currencies to global factors. And what we find is that it looks like foreign currency debt and dollar invoicing are highly correlated with our risk exposures. So, in countries with high dollar debt, it looks like these currencies depreciate a lot when dollar risk goes up. Similarly, for the dollar invoicing, if you have high dollar invoicing, it looks like you are more exposed to carry trade risk. So let me actually, so this is all correlations, right? But our interpretation is going to be, through the lenses of our model, is going to be a little bit causal. So let me tell you the causal story we write from these correlations. So we take dollar invoicing as given. So this is really about the fundamentals of the economy. What is dollar invoicing? It's that when you're exporting stuff to the rest of the world, you write contracts in dollars. Why is this important? This is very important because when you write contracts in dollars, then you don't have the power to change your prices anymore. Why this is important? Because, for example, imagine exchange rate depreciates. If your if your prices are flexible, what you can do is that when exchange rate depreciates, right, your profit goes up, right, because you sell stuff in dollars, so you get dollars. And when exchange rate depreciates, your revenues go up in local currency. So what you can do is to decrease your price a little bit to capture more market share, right? Because your profit margins are higher now. But if your prices are denominated in dollars and you write contracts for like 2 years, you cannot change your prices. So yes, you're going to make more profits, fine, because the value of your exports go up, but you're not going to be able to increase your output, increase what you sell. So what we see in the data is that the higher dollar invoicing you have, it looks like you're more exposed to carry trade risk. So I'm going to introduce another object here, that's the cyclicality of the exchange rate. So what I'm going to do is I'm going to regress for every country, log changes in GDP on log changes in exchange rate. The exchange rate is divided by the consumer price index. So what this symbolizes is the purchasing power of $1. And on the left-hand side, you have the GDP. So what this basically is a correlation. And what does this symbolize is that agents in this economy, households, firms, they see a certain pattern between GDP and exchange rate. And what we are going to find is that in countries with high currency risk, we are going to see high counter-cyclical exchange rate. In these economies with high carry trade exposure, it looks like the GDP exchange rate co-movement is sort of negative. South Africa is a little bit outlier here. And in countries like Japan, Denmark, Switzerland, it looks like exchange rate movements are to correspond to expansion of the economy. At the same time, they have negative exposure to carry trade risk. Because why does this matter? This matters because, why does this matter? This matters because in these economies, currencies depreciate in recessions. So you have local currency savings, right? And in a recession, right, you may be losing your job. At the same time, your savings dwindle because now there is in terms of dollars, they're worth less. But if you have dollar savings in these economies, they gain in value in recessions, which is really good because now your business is not making as much money. So in these countries with high currency risk, carry trade risk exposure, we also tend to see high excess returns. And at the same time, we see high inflation. So whenever these currencies are risky in the sense that whenever GDP declines, correspond to exchange rate depreciations, in these countries we tend to see high average inflation. And why? That is the question we are asking. So we are going to introduce a model. I'm not going to go into details. So this is going to be a small open economy model that we based on roughly our previous model. We are going to have two factors that I discussed in this model. We are going to have dollar invoicing. And high dollar invoicing again means that you cannot increase your exports when your exchange rate depreciates, right? So your expenditure switching is not working as much as you want. At the same time, we introduce dollar debt and financial friction. So if you're high dollar debt, right, when exchange rate depreciates, your economy is going to suffer. So what we are going to do basically is to see how these two variables, how these two factors affect the response of an economy to global shocks. And for global shocks, we are going to use dollar interest rates or foreign interest rates. So this is impulse response functions. So the blue line is high friction economy. Basically, you have high dollar invoicing and high dollar debt, and the black dashed line is low invoicing and low dollar debt. What basically we see is that if we increase dollar interest rate in both economies, what we basically see is that let's start with the low friction economy, exchange rate depreciates like 4%, fine. Exports go up, inflation goes up, GDP goes up, export drive GDP up, so your economy stimulates, your inflation goes up, so your GDP goes up, inflation goes up, and monetary policy raises interest rates to, smooth them both. Great. And your investment is not super affected, consumption not super affected. But in the economy with high risk, high dollar debt, and high invoicing, what happens is that now exports cannot go up as much because your prices are sticky, right? So what happens is the exchange rate needs to really go up a lot. So exchange rate depreciation is the double of the low friction economy. And what does this do is that, this banking system has a lot of dollar debt, so this screws up the banking system, and so your investment collapses. Okay? And this puts the economy in recession. Now you have high inflation due to pass-through, and at the same time low GDP growth. So what is the monetary policy supposed to do? It doesn't do anything in a sense. It's reacts very slowly. And now you see there is a boom in investment. That is because now the balance sheets are destroyed completely. Banking system tries to attract capital to recover the lost capital, right? And to attract capital, the economy needs to give high interest rate spread. So the economy, by increasing its spread, tries to attract more capital. So this is how you get currency returns in this economy, okay? So now I'm going to I'm going to see which friction plays what role. So I'm going to have now here 4 economies: high dollar invoicing, high dollar debt, high dollar invoicing, low dollar debt, low dollar invoicing, high dollar debt, and almost zero friction in a sense. So let's start with the export prices. You see in the economy with low invoicing, your prices are flexible. Whenever exchange rate depreciate, you decrease your prices in dollars. So this is your export prices in dollars. So you decrease your prices in dollars, which means that now you can sell more goods. So your exports expands. And when your export expands, you need to produce more. So to do that, you need to hire more workers. So the economy expands, right? Whereas when you have high invoicing, you cannot decrease your prices a lot. Which means that even though exporters might be making a lot of money, they are not producing more because their prices are sort of fixed. Similarly, when we look at the UIP strategy, we see that it is driven by dollar debt. So when you don't have dollar debt, whether you have low or high invoicing, it doesn't really matter because your banking system is not super affected. But when you have high dollar debt, your banking system is affected because of the exchange rate depreciation. And in order to recover that, you need to attract capital, and to do that, you need to pay a premium. But you see that there is a nonlinearity here in the sense that, here the dollar invoicing plays a big role. Why? Because if your prices are flexible, export prices are flexible like this, you can expand your exports without depreciating your exchange rate that much, which means that your balance sheets are not that affected. Okay? So now what we are going to do is that we are going to look at the steady state of these economies. So whether instead of focusing on the particular shock, we are going to see what happens in the steady state if we increase export price stickiness and dollar debt. What we see here is that with both dollar debt and export price stickiness, we tend to see a more negative co-movement between GDP and exchange rate. So dollar debt only, so this economy also has dollar savings, so dollar debt only matters when it exceeds the amount of dollar savings, so you start having a negative net foreign asset position, and then the economy suffers. With export price stickiness, the more your exports are priced in dollars, the more negative your GDP response to exchange rate movements. And these economies, you tend to see a more volatile, although it's not super linear, you tend to see a more volatile exchange rate. But more importantly, investors seeing that now that GDP loses a lot of value in a recession, now dollar assets are more precious because dollar assets give you an insurance, right? Because whenever there's a recession, dollar assets gain in value. So you want to save in dollars, or you want a premium. You want high interest rates to hold local currency. And that is precisely what we see in the steady state. And then, if the monetary policy reacts only to inflation or only to output and doesn't react to this risk premium that is demanded by agents, now the monetary policy is in a sense too loose. And in order to convince people, so in a sense, people would like to, they demand high returns. So what happens is that we see a high steady state inflation. And where does this come from? Let's consider the basic Taylor rule. So imagine Taylor rule only responds to inflation. But people demand higher returns to hold this currency, right? So what happens is that the only way to convince the monetary policy, in a sense, to give high premium is to have high inflation. So high inflation is going to increase nominal and real interest rates because this coefficient is larger than 1. So the idea is that when monetary policy does not respond to the risk premium, inflation goes up to force monetary policy to respond to it. All right? But in a sense, this is like, in a sense, here the monetary policy is following inflation, right? So you see, what we are going to see is high nominal rates, high real rates, but at the same time, high inflation. So thank you very much for listening. In this paper, we argue that what matters in terms of currency risk is how does the economy respond to global shocks. And if an economy doesn't have a really good exchange rate insulation, you tend to get a volatile and a more counter-cyclical exchange rate. And this volatile and counter-cyclical exchange rate makes investors demand higher returns on average. And if the monetary policy does not respond to this high risk premium, then you get high structural inflation. And thank you very much, and happy to receive questions.